Hi everyone, welcome back to my channel. Today I want to cover Warren Buffett annual letter to all his investors, and I'm pretty sure that it is a very interesting letter. A lot of the world-renowned investors and even retail investors like ourselves will actually look at the article, look at the letter that he wrote, and to really draw some insights or wisdom from this godfather of investing. But of course, sadly, that his right-hand man, or potentially his sort of mentor, I mean, based on the letter he said, Charlie Munger is no longer with us. Of course, again, Charlie Munger's wisdoms and memories and his knowledge of the world of investing is still very, very important to where we are at this time. Okay, so I'm going to dive right straight into it. Okay, I think Charlie Munger, like I said, passed away 28 November, 23 days away from his 100 years old birthday. And again, is in this particular letter, the first page is actually given to Charlie Munger by Warren Buffett. He actually credited him as being the architect of where this particular company, Berkshire Hathaway, is. Truth enough in a sense, because a bit of their backstory is Warren Buffett has a way of investing. He learned from his mentor, which is Benjamin Graham, in terms of how to evaluate companies. But when Charlie Munger came into the picture, he changed the way Warren looked at company today, right? In terms of how he wants to invest and how he is okay to actually buy companies sometime at a higher price if the company is a fantastic company itself. So, and this is a very important quote that they always say, right? Price is what you pay, but value is what you get. So it is certain principles in regards to value investing. Okay. And of course, when I mean you think of it, right? When Warren feels that Charlie is the architect, right? It tells a lot about how they look at wealth, right? When you look to wealth, I have a very similar concept. It's like a building, right? When it comes to building, there's a few elements that we want to have for ourselves. Number one is a blueprint. Like, do you have a blueprint of how do you envision your wealth to be? Right? Do you sit down and really decide in the next 10, 20, 30 years, right? What kind of wealth do you want to create? Because wealth will need time and will need your returns to compound, which is a snowball effect of where money will constantly grow and grow and grow. And 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 it's not a get rich quick kind of strategy. It's really compounding, using the power of compounding to build wealth over time. Okay, a few things from his letter that I think is very important, and later I will share the most important in his particular letter, right? So there are 2 points over here. One thing is short term, the stock market is likely to act as a voting machine, but in the long run, it become a weighing machine. So what it means is like, in the stock market, people will say what? Buy today, buy tomorrow, sell today, etc., etc., etc. But over time, right, it becomes a weighing machine because why? There might be multiple people buying and selling, right? And when more people buy, obviously the share price will go up, right? So the weighing machine will basically weigh how many votes are there, right? So on a daily basis, the both of them don't really look at the share price of the company, right? They only evaluate certain factors that it is actually covered in this particular letter, right? Like, so the first point it goes into is really good economics that are fundamental and also enduring. So fundamental, very simple, means it is important for the economy, right? It means like the economy need to use it, and it's enduring. Enduring means, again, it's long-term, there's growth, and there are challenges, and the business are able to overcome all the challenges, whether is it high interest rate, low interest rate, or going through multiple recessions, as all this business has, right? Like such as like Coca-Cola or even American Express or some of the companies that he holds like Apple, right? They have went through enduring times, whether the 2000 dot-com bubble, the 2008 financial crisis, and also 2020 COVID-19 crisis also, right? So one factor is there. The second factor is able and trustworthy managers. Means he want the CEO or the management team to be capable people and people that they can trust and probably align the manager's interest and the shareholders' interest together. Right? I think this is very important because there are some CEO out there, their interest is always above the shareholders. Means they will go to parties, they will buy private jets, and they will fly their families around the world for holidays. But I mean, of course, the company still run at a profit. But the problem is when the CEO abuse the system, a lot of this money is funded for their lifestyle instead of the actual business, for the business to be growing. So Warren Buffett take a lot of time to really understand all the managers. And in the many, many letters, right, he always talk about people that he met and how he got to know them as a person, not just as a manager or the person running his company in a sense. Going down some more. Then, of course, the third thing for him is that, when he say things like most important, right, in an article like this, right, then obviously you need to capture all these keywords, right? So he said, for them, he's always trying to operate in a way that will have the least risk of permanent loss of capital, right? So, and to them, right, it's actually better than trying to make more return, right? Over there, the second phrase he said. And they do not want to have a chance, right, that their capital will go into a total loss, which is one of the most fundamental of how they constantly compound their money. So you think of it today, right? Ask yourself, evaluate the portfolio you have, evaluate your assets today. Are there assets that potentially can go to zero the next day? If there are, it is about time to really relook at the asset and what you should do about it. Okay. Then again, he repeat himself. Some assets are fundamentally good, but sometimes could be strikingly mispriced. So sometimes certain assets that they hold might be mispriced due to the time they are in terms of recession, or even probably accounting measurements, accounting standards also. Okay, then again is a warning over here. He actually feel that today, right, I mean, comparing to his earlier years, right, today's active participant or investors, right, are neither more emotionally stable nor better taught than when he was in school, which is like, he's also in his 90s already, by the way. For whatever reasons, right, the market now exhibit far more casino-like behaviors than they did when he was young. So it is telling us that he feel after many years of investing, like probably 80 years of investing, right? He feel that, hey, the current stock market, even though they have went through so much lessons, so much crisis, history has sort of teach many lessons to us, right? But yet people are still very like treating the stock market as a casino, right? Really speculating the money. And it's getting worse now, right? It's really very bad. And there goes, he repeat again, never risk permanent loss of capital, right? So to me, when I see him repeating a few things again and again, right, I wonder, is he trying to tell us something, right? So if you are watching this video at this point, I hope that you will like, subscribe, and share to your friends, because I think he is really warning all the investors around the world, be mindful, okay? Then another thing for him, right, is that we did not predict the time of an economic paralysis, right? But we were always prepared for one. So for them, right, one of the things that he always say, right, if you are someone that have not invested now, and you're trying to analyze A to Z and then Z to A, right, and you can't stop thinking and analyzing, right, then you might go into this thing called analysis paralysis. So you'll be paralyzed by your analysis. That should not be the approach. because for them, their approach for so many years is always preparing for one. And that is one of the reasons why their cash balance is at this moment one of the highest, right? About 160 or 150 US dollar, billions of dollars in that sense. So, and whether are they expecting a recession to come? We have yet to see, but a lot of their investments or a lot of the companies they invested is very capital intensive, right? So many of times, right, they do not want to go to the capital market to borrow money. Instead, they will prefer to use their own money, right? Why do they want to do that? Very simple. They do not want to be in the mercy of lenders, in that sense. Like the global financial crisis, when bank was in a deep crisis, right? They were other than the central banker as the last resort of lenders, right? Actually, a lot of the bankers actually went to Warren for money to really say that, hey, can you fund our balance sheet? And he did. He funded a few banks. And after the crisis, he actually made quite a decent amount of return from them. and one note for them, for him, right? He actually want the company to build to last. So again, another warning relating to permanent loss of capital, right? So again, I don't know why he is repeating this. This is one of the few times that he keep repeating the same thing. Then another point in regards to how he look at businesses is what is sensible at a discount to business value, right? So mean business value becomes stupid, right? If done at a premium. So it seems like he is telling people at this point of time that some asset potentially is worth investing. But when it is done at a premium, at a price that is so high, it seems pretty stupid to do it, right? I think with him saying this, right, it again testify that even though he has so much money to be invested, right, he is always very patient and very picky with the investments that he wants to go into. But of course, saying this, I need to give you some context, right? The way he invests is really in sizes of billions, very different from the way we invest. So some of the things that he do or the companies that he invests, we need to see it in totality, right? See it in a way that he diversified his risk away from the uncertainty in the market also. Then again, this is the last one. He and his one of the very capable manager potentially going to replace him. This is the guy. Both of them believe that they cannot forecast the market price when it comes to currency, right? Maybe they can do some prediction, but they do not believe that they can hire anyone with this ability. So instead of doing that, they just receive it as it is in that sense. But of course, because we are Singaporean, some of the assets are either in the other currency. It is also very important for us to take note that after accounting for all the currency gains or losses, right, are we still in a plus in a way? It is very important. Okay. So I think these are very important. But of course, the last thing that I want to share, right, if you really read into the kind of companies that they invest, right, like financial services, electricity, oil, and railway tracks, railway companies that bring the logistic around US, right? These are businesses that are basically fundamentally going to be around for a very long time for the US economy. And again, is where it's enduring also, right? It's enduring. Like for example, one of his companies is in oil, right? Back then, US wasn't a major supplier or producer of oil, but because of certain dynamics in the country, they allow fracking to happen, right? Suddenly, US at this moment is one of the major producer of oil, right? They are actually now a net exporter of oil. And these are very fundamental shift, right? So do look at trends that are happening around the world. If you do not know what are they, we can always have a conversation in regards to this. But when you can spot trends or fundamental shift in the stock market, in the economy, that's where you want to get ahead of time to start investing into it. and you will really maximize, you will get sort of asymmetric kind of returns, right? So again, like Warren Buffett say, right, most importantly, reduce the risk of total loss, okay, or permanent loss of capital. So if you watch to here, thank you for following this channel. Thank you for supporting my journey. Continue to like and share and subscribe. Okay, so see you all again for the next video. Goodbye.